What are Mello-Roos taxes? Have you ever heard of Mello-Roos taxes and wondered what they really are? Let's break it down in simple terms. Mello-Roos taxes are special property tax assessments found in California. They were created under the Mello-Roos Community Facilities Act of 1982. These taxes are designed to fund local public infrastructure and services in specific areas known as community facilities districts. So, what does this mean for you as a property owner? If you live in a community facilities district, you will pay these taxes in addition to your regular property taxes. The money collected from Mello-Roos taxes is primarily used to finance new or improved community facilities. This includes things like schools, roads, parks, and even police and fire protection. These taxes are especially common in newly developed neighborhoods where the necessary infrastructure is not yet in place. Now, how does the process work? Local governments or developers can form a community facilities district. They then issue bonds to raise money for these public improvements. Property owners within the district repay this debt over time through annual special tax assessments. Unlike standard property taxes, which are limited by Proposition 13, Mello-Roos taxes are not based on property value. Instead, they are typically flat or formula-based parcel taxes that can change to meet the district's financial needs. For banks and credit unions, Mello-Roos taxes representing an additional financial obligation tied to the property. This is similar to having a secondary lien or mortgage. If Mello-Roos taxes are not paid, it can lead to accelerated foreclosure proceedings. This can happen as soon as 150 to 180 days after a payment is overdue. Lenders must take these taxes into account when assessing a borrower's ability to repay a mortgage. When buying a property, it is important to know about Mello-Roos taxes. Disclosures about these taxes are legally required during property sales. This ensures that buyers are aware of the ongoing special tax burden they will be taking on. In practical terms, Mello-Roos taxes increase the annual cost of homeownership. They also affect loan underwriting since lenders include these taxes in debt-to-income calculations. Since Mello-Roos taxes can vary and are not capped by Proposition 13, they may increase over time. This can impact long-term affordability for borrowers. Understanding Mello-Roos taxes is essential for banks and credit unions to accurately assess property values and determine loan eligibility. In summary, Mello-Roos taxes are special assessments levied on properties within designated districts to fund community infrastructure and services. They create an ongoing tax obligation secured by the property, which lenders must consider when issuing mortgages.